Hey guys, JC Peretz here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action. I am joined, as always, with Steven Straza. Straza, let's get it. Bonds, Bitcoin, and big tech. Is that the playbook for 2023?
I think it might be. 2022 was all about the dollar, right? We were watching the dollar like crazy. As soon as it peaked, that's when risk assets started working. I think 2023 might be about interest rates. And this is very much an interest rate story. I don't have to explain bonds, but Bitcoin and big tech are long duration assets. They do better as rates fall. And I think that's what's being priced in right now.
I mean, the 2-year yields had its biggest drop in 40 years or something like that, right? So as interest rates were going up, bonds obviously were going down. Bitcoin was under pressure. Technology, anything long duration was under a ton of pressure. And now with interest rates rising, you're seeing that selling pressure sort of let up. And technology stocks are doing well. They're outperforming. You're seeing it in the NASDAQ. Bullish outside week last week. You're seeing Bitcoin. At this point, that 30,000 level is, for me, front and center. I think we ultimately get above it and we're off to the races. But, and you make fun of me because you say that I like this chart, but, it shows Bitcoin, MicroStrategies, Coinbase, Riot, Marathon, ARK, even Square. They look the same, Straza.
Yeah, and you've zoomed way out on this. If you were to zoom in, these charts are working right now. I mean, These Bitcoin miners, these Bitcoin stocks, Coinbase, Square, ARK, this is where you want to be. And I think all comes back to interest rates.
So it's not just big tech, it's little tech too.
To an extent, but it's more big tech.
Yeah, definitely. All right.
When we talk about these 3 Bs, like we just said, it's very much an interest rate story. So would you include gold in that conversation? Bullion, 4th B.
I think you have to. I don't necessarily know that it's because interest rates are rising. I think that makes less sense. I don't necessarily think it's an interest rate thing. I think it's just a strength thing, right? So when we talk about Bitcoin, we talk about big tech, we talk about bonds, there's strength in those areas. And I think we could point to interest rates in that case. In the case of bullion, I think it's just strength, right? So I think you can add the 4th B. The more times the level is tested, Straza, the higher the likelihood that it's going to break. And gold keeps pressing up against these 2011 highs. I think ultimately we break out, no?
I mean, what are you trying to say? There's no such thing as a triple top?
I mean, we're looking at it like a quadruple top at this point, no?
Listen, it's a nice base, been knocking on the door, absorbing this overhead supply for several years now. I think we get it done this time. I think it makes sense. And if you're not sold on the interest rate story, next chart, please. Just look at, we know the dollar for it, but if you go to the next chart, 2023, they've been moving in lockstep in the opposite direction, right? As yields were moving higher through February, gold was selling off and correcting. Since rates peaked in early March, gold bottomed and has been ripping higher. I think that's what it all comes back to. We want to.
No, you're not wrong. I'll point to the silver gold ratio. If you think gold's going to break out, and I do, think you need to start to see silver really outperforming. When you look back, when precious metals are doing well, silver's the leader out of that group. We haven't seen it yet. But if we start to see gold at 2,200, 2,300, I have a funny feeling silver's going to be ripping in that environment.
I couldn't agree more on this one. You want to see the animal spirits come alive in the space. Right. This is our risk-on barometer for precious metals. I would also look to silver on an absolute basis. We're back in the box, back above that 2140, 2150 level. That was such a key area of interest. So we're repairing the damage. We've come a long way just in the past few weeks. This is an area we want to continue to watch.
All right, Straza, growth gains on value. Growth stocks just had a monster week. How do you feel about growth versus value relationship here?
Well, show the next chart. I mean, we like to use IWF and IWD to look at large cap growth versus value. These are the Russell 1000 indexes. They give you a more comprehensive view than the S&P indexes would. We have a key level here at the dot-com bubble highs where the growth versus value ratio peaked over 20 years ago. We're right back at the scene of the crime And at this key level, we're thrusting, right? So huge momentum thrust last week. This is the second highest reading we've seen in history. When I say second highest reading, this is the second highest outperformance we've seen from growth over value. So I think these stocks or this factor is really telling us something right now. I think it would also, the market is designed to fool the majority. As soon as everybody's come around to the story of commodity stocks and value and growth and tech, are out the window and Silicon Valley Bank is blowing up, I think sentiment is also ripe, right, to really catch people off sides and the markets move back into a place where it's favoring growth again. This is the level above the dot-com bubble highs. I think you have to be overweight growth again.
I think you nailed it when you brought up the financials, because when you look at growth versus value here in blue, and then in black, you're looking at tech versus financials. And with the damage certainly done in the financial space, as it turns out, the tech versus financials ratio found support at those dot-com bubble highs. So growth versus value broke down below those levels, but tech versus financials did not. They held. So is that the canary? Is that pointing to higher growth relative to value? It's hard to ignore all of that buying pressure. And as you said, the 1 week rate of change is the highest that we've ever seen on record. And thrusts around here are not things that we like to ignore. We like to embrace this sort of thing.
When it comes to tech and growth, nothing looks better than semiconductors right now. Are you bullish?
I mean, around here, we like relative strength, right? And look at semiconductors at its highest level since 2006 relative to the NASDAQ 100. So, I mean, when I see relative strength like that, it's hard for me to ignore it. And let's think about the broader market implications. We look at semiconductors like part of Dow theory. You got the companies that make the goods and you got the companies that deliver those goods and services. It goes back to the late 1800s. Goods and services are not delivered using railroads like Charlie Dow once envisioned, and they're using computers and semiconductors. And I don't think it's a coincidence that the S&P 500 and the semiconductor index literally trade tick for tick with one another. So when you're seeing outperformance out of semis, you're seeing absolute performance pushing up against new 52-week highs. I mean, we're making like 47, 48-week highs, like very close to 52-week highs. I think semis look good. I think it's a place that we want to be. And On Semiconductor is a name that readers of All Star Charts are quite familiar with. This has been a big winner for a long time. Stair step higher. For me, it's very simple. If we're above 71, I like it long. I think we go to 115. Below 71, leave it alone. But the risk reward is very well defined. Above 71, we want to be long on semi. The target up near 115. It's technology, it's growth, it's the outperformer within technology, which is semiconductors. You're seeing the performance on an absolute basis. The risk is well defined. The potential reward is exponentially greater than that risk. What else you want?
I think you just about summed it up. You didn't even leave a second's time for me to say anything. So yeah, that's great. Next topic.
You disagree with any of that? I don't think so.
No, and you're right. They're the lifeblood of the global economy, so it's very important from a macro standpoint.
All right, Straza, last week we discussed the bond market volatility, and it only got worse. What's the message from the bond market now?
I mean, we could just go right through it. We talked about this chart last week, right? Is stock market volatility going to catch higher to the bond market? Bond market volatility hasn't been this high since the financial crisis. I'm finding myself saying that a lot the last week or two. Hasn't been this since financial crisis. It's usually not a good thing, right? Direct you to the U.S. 2-year yield. On a nominal basis, we haven't seen this big of a move since the late 1980s, really Black Monday, 1987. Same thing for Treasury spreads. Haven't seen this big of a move since the early 80s, right? This is all speaking to bond market volatility. If you look at the next chart, look at what happens when the spread starts to turn higher in the past. In fact, the last two crashes, maybe even last three crashes, if you want to include COVID, happened when this chart, the 2-10 spread, turned around, started moving higher again. We could say the same thing about credit spreads, right? We had a little breath or a momentum thrust there. Credit spread, multi-month lows. I wouldn't say they're at red light cautionary levels, but it's something we really want to watch. And then inflation expectations, biggest COVID. So all of this speaks to bond market volatility. What is one thing that we know about bond market volatility? Typically not a good thing for risk assets or the broader market.
funny thing about bond market volatility is that it hasn't spilled into other asset classes. We might have seen bond market volatility. We haven't seen any stock market volatility. We haven't seen any commodities markets volatility. We haven't seen volatility in the Forex markets. And I think if the markets were really spooked, you'd see a flight to safety into the US dollar. You haven't seen it at all. You'd see volatility in the stock market spiking. We've seen some spikes in financials, but that's it. So I'm waiting to see if there's going to be any spillover into other asset classes. We haven't seen it yet. So first thoughts, Straza.
This is a little game we like to play. I'll say a word or a phrase. You tell me what the first thought that comes to mind is. FOMC.
FOMC. I mean, my first thought is who cares? I know, if we were in the, if we were journalists or whatever, we have to make a big deal about it. Fortunately, we're not journalists. If we were economists, we'd have to make a big deal about it. Thank the Holy Lord. I am not an economist. For me, if I'm interested in what the Fed funds futures are doing, I can just look at the Fed funds futures market, right? I don't have to worry about what this Fed governor said or what that one did or this one speaking. Like, I don't care about any of that stuff. The minutes, I don't know. They're so lagging. Like, who reads that stuff? So for me, the first thing that come to mind when you say FOMC is, who cares? You want to know where Fed funds are going? Just look at the futures market. That's all the information you need.
You're not wrong. Thank God. Thank you, CME, for giving us the Fed Watch tool. Some great information. But the rest of the market seems to care. This is all everybody's talking about. JC doesn't care, but tomorrow is the March FOMC meeting. I like to pay attention. It's fun. This is all entertaining for me. I think they're done. The Fed is done. Here's the pickle that they're in this meeting. And this is fun because it's been over a year, right, since we didn't know what the Fed was going to do. We've known exactly what they were going to do at any meeting for the past year now. We don't know tomorrow. It's either 25 or 0. I think they do 25 to save face. They really don't want to, but I think they do more damage by doing 0. I think that would spook the market. People will start asking, well, what do they know that we don't know? They've been in all these meetings with the regional banks over the past 2 weeks. I think they do 25, and that's it.
Right, 2-minute drill. We continue to see the prior cycle's highs come into play in various asset classes. Let's talk about some of the major levels that we're watching right now.
When I did my chart book review this weekend, we know that polarity is real and these prior cycle highs are so important, but with the selling pressure over the past few weeks, they're all coming back into play again. We can go through asset classes, through sectors, through different indexes. Start with the dollar, right? We got the 2016, 2020 highs. That's acting as support right now, was resistance. If this level breaks, it's a great thing for risk assets. If it holds, we'll have to see, right? But you don't want to see the dollar rebound higher off this level. Say the same thing for interest rates, right? So from an intermarket standpoint, these charts are incredibly important. If these levels break, good thing for risk assets. Look at the Russell 2000. We have the 2018 pre-COVID highs right here. We keep knocking on the door, keep testing this level. Don't want to see that break, right? Stock market investors, that'd be terrible. Bitcoin and Ethereum, we've been looking at the 2018 highs. So we could just keep going down the line. And these are your levels, right? If you're looking for a line in the sand, if you're looking for some sort of signpost or some way to protect yourself and manage risk during the volatility, look at these prior cycle highs. This is just such a great roadmap. Thank God that we have this price memory to use to our advantage.
To me, I think you nailed it. All of those are incredibly important. You look at the Russell 2000, you look at the US dollar coming back and retesting that former resistance. But I think this is the one right here in America or anywhere in the world. We don't have bull markets without financials at least participating. If financials are crashing, chances are the stock market is probably not in a healthy state. So we're looking at financials going back to the pre-great financial crisis highs back in 2007. That was resistance in 2018, resistance again in 2020. We ultimately broke out above that, and we're back to the scene of the crime again. This served as support last summer. It was a major pivot in the overall market, and we're back there again. If you see a 29 handle in the XLF and we're below 30, I think that's a big problem for stocks. Forget rates, forget the dollar, forget all those other things. I think it's this simple. If financials are below 30, I think that's a big problem. My caution radar will be very up, and I will be, any positions I have will be much smaller. I will be very, very careful in the market because I think in that scenario, systemic risks are elevated, and I will be much more cautious in everything I do if we are below 30 in the XLF. I feel that firmly about it.
This is the most important chart, most important level in the market right now. Thank God, with the environment that we're in, with financials coming under pressure, we have this line in the sand right here, because I wouldn't touch the space if we're below there.
Yep. All right, final word. What do you got?
So let's just keep it with financials. If you want to step into this space right now and, put on some risk in financials, buy the ones that are working, please. Relative strength. And relative strength becomes, such a more valuable tool during periods of volatility, right? So the whole space is under pressure, yet Interactive Brokers Group is making new highs relative to XLF. We have a beautiful base here, really clean level to trade against. If you're above 80, I love this stock. I love the company. Long IBKR all day. Buy the ones that are working. Don't buy the ones that are selling off.
All right, my final word is the strength in Bitcoin. I can't get over it. If you would have told me all of the things that we'd be seeing in the first quarter of this year and Bitcoin doing what it's doing, I would have said Ethereum's got to be like around 2,500 or something like that, 2,400. That would have been my guess. And that guess would have been incredibly wrong. And when the market does certain things that are unexpected and, you think it's going to be one way and it's another, I really like to pay attention to that. And what I'm seeing is Bitcoin dramatically outperforming Ethereum in this environment. And rather than overthink perhaps the inner market implications of something like that, I think it just reiterates Bitcoin. It's like, trade what's in front of you. This is a big one for me. I still think it's got some work to do to get above 30. That's the big test as far as I'm concerned. Remember when that broke 30, we're like, oh, who knows how low it's going to go now? Well, here we are back to that 30 level. I think if we are able to break out above 30, Straza, I think we rip through those old all-time highs and we go straight to 100,000 when we get that 100,000 roll. But we got to get through 30 first. But I can't get over the outperformance out of Bitcoin. I mean, are you equally surprised, or is this not surprising to you?
I mean, listen, we got to get through 30 first, but the first test was, sorry for beating a dead horse, but look at these prior cycle highs and look at how they held in. I mean, that was major information for the past quarter or two. Other areas of the market were getting blasted, and Bitcoin and Ethereum were holding their prior cycle highs. So I think that was a big tell. And now we're seeing a move back to the upside. I think new uptrends are underway for crypto.
All right, guys, thanks for watching. Make sure to give us a like and hit the subscribe button so you never miss an update. And follow me at All-Star Charts on Twitter. And make sure to follow Steve at S Straza. Leave a comment below and let us know what you think. See you next week.